afternoon, everybody, and thank you so much for joining us for this great webinar with guest speaker Dyches Boddiford. My name is Larissa Green. I'm with Advanta IRA, and in just a second, we're going to invite Dyches to finish the second part of a two-part webinar he started with us a couple weeks ago in talking about private money or hard money lending with a self-directed IRA. I am Director of Education with Advanta, and I've been with Advanta a little over 6 years now. We really pride ourselves on our education. It's very important to me that everybody have access not only to the presentations that we do live at our offices, but also to the webinars. So if you did miss the first part of this two-part webinar series, we will make sure that you get the recording through a link when we send out the link for this recording as well, and you'll also receive the slides from Dyches' presentation. If you have any questions, please make sure to type your questions into the chat box. We are going to be taking questions throughout the seminar, so go ahead and put them in there. We don't take the raised hand just because we like to keep the webinar moving forward, and also we do mute all participants. So go ahead and type your questions into the chat box, and we'll make sure to get those answered. Just a little bit about Advanta. We are a self-directed IRA administrator. That means that we hold non-traditional assets in your IRA. We can help you with a wide variety of investments, and I'll talk about that in just a second. But something that we don't do is provide legal, tax, or investment advice. Now, I always encourage people to ask questions, but if we can't answer your questions, then we'll be able to refer you to some professionals who can help you with those questions. So ask anyway, and we'll see if we can't put you together with a professional that can help you. As I mentioned, education is very important to us here at Advanta, and we have lots of different ways that you can access anything that we're holding through our office. You can always check out our advantaira.com/events page for anything that's upcoming. We have a lot of great webinars that are coming up in the next couple of months, so definitely check that out. Another thing you can do is check out archived webinars on demand at our Learning Center and also on our YouTube channel. So again, if you missed the first half, you will get the link to that, but you can also check it out in those locations as well. What type of plans can we help you with? Well, if it ends in IRA, it can be self-directed. It can also be any old or former employer plan. And also, sole proprietors or individual business owners may have plans for themselves and for their small businesses, and we can help you with those as well. A couple other accounts that are eligible for self-direction are going to be health savings accounts and education savings accounts. And the rules for self-directing, those are the same, so we can certainly help you with those types of accounts here at Advanta. Different types of investments. Well, there's really no list from the IRS that says this is what you can invest in. What they've done instead is provided a list of rules that we abide by when we're making those investments. And I won't be going into those too much today, but if you want to join us for another webinar where we talk specifically about the rules and guidelines that we abide by, please do so or email me, and I can definitely send you a link to one of those webinars. But what I'd like to do instead is give you an idea of the different investments that we see here at Advanta. So first and foremost, real estate is the most common investment we see, and it's real estate pretty much in any form. It can be commercial real estate or residential. If you like to hold rental property or invest in tax liens or deeds, all of those things are permissible in an IRA. We also see things like gold and silver bars or coins and other types of metals. And you can invest in those metals as long as the value is based on what it is trading at. It can't be something that's considered rare or collectible. We also see private stock, so it could be investing into a restaurant or a brewery or something even like a local bank. We see investments into partnerships and private equities. We've seen commodities, and then of course what we'll be talking about with Dyches in just a minute, private lending. And I wanted to just quickly give you an idea of how that works. Basically, when the IRA is lending money, it's acting as the bank. And so when you're lending money from your IRA, you have the opportunity to determine the terms that go along with that, just as if you were getting a loan from a bank. So how long are you going to lend? What kind of collateral is there? What is the interest rate? All of those things are determined by the IRA holder. What we do here at Advanta is make sure that that investment is properly vested in the name of the IRA, and then we receive any income. And of course, if there is an expense to that investment, we also pay the expenses on behalf of the IRA holder. And with that, I'm going to turn the seminar over to Dyches. And like I said, if you have any questions, just type them into the chat box, and we'll be answering questions as we go. Dyches?
Thank you very much, Larissa. We have talked in the past, the first part of this webinar, we talked about hard money lending. And just to remind you, hard money lending really refers to the use of collateral as the main source of repayment, as opposed to depending on the credit level of the borrower. That doesn't mean we don't concern ourselves with the credit, but more so to determine that they will make payments on time than it is for actual repayment of the loan. We're looking for the collateral itself, the hard asset, to stand for the loan primarily. And hard money lending is many times private, such as you or I making those loans, maybe a small company making those loans. In other words, they're not institutional type of lending. So when you hear somebody talk about private lending, oftentimes they are talking about hard money lending and vice versa, because most of the institutions aren't qualified under their regulatory oversight people to make loans based strictly on the assets, which we can do as private lenders. We can do that outside of our pension plans or inside of our pension plans. And self-directed IRAs and self-directed solo 401ks are certainly an excellent source of funds to loan for either short-term or long-term based on the hard assets for repayment if for some reason the borrower defaults on us. Today we're going to talk about going and putting our lending into a higher gear by using something known as wrap lending. Let's talk a little bit about that in a minute, but first of all, let's say that before you get into using wrap lending or anyone else using any other monies besides your own that you might have in your IRA or other plan, you want to use that money first and get your experience. One thing you don't want to do is you do not want to pool funds from several different people, whether it's inside or outside of their IRAs. You don't want to advertise for capital. Both of those will give you problems with securities agencies and the brokerage laws in your state. If you do work with other people, you might want to partner with them, and both of your names being on the lending documents. And it would be presumed 50-50 if it said something like John Smith and John Doe as the lenders. Or it might be uneven, like John Smith as to 80% and John Doe as to 20%. So you can have a loose partnership with someone else, each of you putting up a portion of the funds for a loan. Now, generally, they're going to receive the same interest points and so forth in proportion to the amount of funds that they lend. So if it's an 8% loan, then they're going to get 8% on the amount of funds that they put in, as well as you getting 8% on the funds that you put in. One problem with having a partnership of people lending is they all must agree on any actions that are taken, unless there is a separate partnership type agreement that will specify that one person gets more than another person. One person has the responsibility for, say, collections. One person might have the responsibility for maintaining the records for the lending. And if you have multiple IRA accounts, for instance, that are partnering together to make a loan, you want to have the borrower cut checks separately to each funder for their portion of the payment. So the total amount is whatever the note shows that the borrower should be paying each month, but that's divided up among the lenders, either 2, 3, maybe as many as 4 lenders. Could have more, but it gets a little cumbersome after 3 or 4 lenders. And they can actually cut checks to each one. This is we've done this in the past. It's not very complicated at all, and borrowers typically understand as long as the total is not more than the monthly payment that they agreed to pay. Now, wrap loans is another way to put several different sets of funds together. Again, it can be inside or outside of the IRA, And if it's non-disqualified people that are doing this, some could be from our self-directed IRAs, and some funds could actually be private funds. Be careful about the prohibited transaction rules and disqualified parties. I consider using wrap loans as a way of supercharging a hard money loan, a private loan. Let's talk about what a wrap is. It's whether you're wrapping either an existing or a new loan that's in first position against a property, and you're putting on a second loan that wraps that loan with additional funds. Now, the entire wrap, including the underlying, has a higher interest rate than the underlying. For instance, the underlying first mortgage might have a 6% interest rate, and you wrap that with additional monies in a second position, and the whole loan might carry a 10% interest rate. The wrap points and prepayment fees that are included in the other underlying loan is also included at the same percentage or level in the wrap portion of the loan, or it might even be greater. The wrap holder agrees to pay the underlying with any payments received from the borrower. Now, that means that the wrap lender, the person in the second position, is saying, okay, you pay the full amount of the wrap, which includes the underlying, to me, and then I will make sure that the underlying loan is paid to them from those funds that the borrower is paying to me. That's one of the characteristics of a wrap loan, so that the borrower doesn't pay directly to the underlying lender. Rather, they pay to the wrap lender the full amount, and the wrap lender then pays the underlying lender. And notice that I said out of any payments received from the borrower. So the wrap lender has no obligation to make payments to the first mortgage holder unless they receive payments from the borrower. Obviously, the first mortgage holder has priority position in the lien sequence, so that if the first mortgage lender doesn't get paid, they can start a foreclosure and complete a foreclosure. The second lender, the wrap lender, has an incentive to keep that first lender paid so that their position is not foreclosed out. Now, they don't have to wait until the borrower pays the wrap amount to pay the underlying lender. If they want to make sure that they protect their position, they might go ahead and advance monies to the first mortgage holder and start a foreclosure of their own because the borrower is in default and not making the payment. So just understand the positions of the two loans that are involved in this. By the way, a wrap loan could be made around two underlying loans. It doesn't have to be just one. Most often it's just one, but the underlying number of loans could be 2, 3, even 4. All right, let's look at a diagram. Let's look at what an ordinary first and second loan might look like. If we have a property that has a fair market value, and that's documented by the line at the top, then we have two loans against this property. A first mortgage that starts at the bottom of our diagram and goes up, and then a second mortgage above that. The total of the two mortgages are the loans that are on the property, and the difference between the fair market value and the total of those two loans is the equity that's in the property. And you can calculate the loan-to-value ratio by taking the total balances of the first and second mortgage and dividing that by the fair market value of the property and just making that a percentage. Usually, if for your second mortgage holder, you don't want to go above 70, 75%. In our case, we don't make second mortgages. We do make wrap mortgages, but we don't want to go above 65%. So you can set your own loan to value as to how much of the equity you require to be secured for the loans. Okay. Now, notice that the first mortgage and the second mortgage are totally separate. Each carries a separate interest rate. That's the horizontal arrows showing a lower rate for the first mortgage and a little higher rate for the second mortgage. That's typical for most first and second mortgage situations. But now let's look at how a wrap is structured. In this case, we still have the first mortgage. Actually, the paperwork doesn't change at all for the first mortgage. It carries a certain interest rate and obviously a certain loan amount. But the wrap loan is structured a little bit differently. Now, instead of being just on top of the first mortgage, it wraps around the first mortgage. The language within the second loan document makes that statement that it is inclusive of the first loan and refers to that particular first loan that is against the property. We may still be looking at the same loan to value. Remember I said that we don't like to loan over 65%. Some people will go up to 70, even 80%. I think that is a mistake. If you get too high a percentage and your borrower defaults and they haven't completed the rehab of the property or other problem that might come up, you may not have enough money within the value of the property to finish it out and get it resold for its full fair market value. So I think you're taking risk above that 65% or so level. All right, now remember I said the paperwork for the underlying first mortgage is the same as any first mortgage against the property. And remember the wrap documents, the note and the mortgage are they do refer to the underlying loan that is on the property as well. That's the difference in first and second mortgage and the first mortgage with the wrap second. Now let's look at a couple of examples here. An investor has found a house that when fixed up will be worth at least $150,000. The investor has been able to negotiate a purchase price of $100,000 with $10,000 down and seller carryback financing at 10%. Interest only, monthly payments with a balloon in 6 months. The house needs $5,000 in fix-up for paint, carpet, what we call a fluff job. The investor wants to flip the house and comes to you to borrow the money. You happen to have $15,000 in your self-directed IRA, and you decide it's a good deal. Now, that last sentence is very important. One thing you should always remember, if you're not willing to buy that deal on the day that you make a loan for the amount of the loan that you're making, then you should not make the loan because you may be buying the property, you just don't know it yet. You want to make sure that it is a good deal. Don't loan on deals that are not good. You can lose a lot of sleep over that. I can tell you that from experience. Back in the 1980s when I started doing hard money loans, there were sometimes I made the loan and someone would get behind in payments maybe, and I'd lay awake at night and say, "Dear God, please help them pay. I don't want that property." Well, you'll sleep a lot better when you say, "Dear God, I hope that they will pay, but if they don't, I got plenty of equity in there to fix it up and resell it and actually make a profit beyond my loan that I made." So make sure it's a good deal that you're getting into. One of many solutions. You offer to loan the investor $15,000, but will wrap the seller's loan at 15% and 0 points. Points are just a discounting of interest on a loan. We'll look at some examples with points in it in a minute. The investor will make monthly payments of interest only for 6 months. Then the full repayment is due. Procedure and documents. Direct the IRA custodian to send $15,000 from your IRA to the closing attorney. By the way, you should always use a closing agent for any loans that you do. If you're in a state that uses title companies, that's fine. Or if you're in a state that uses attorneys, use attorneys. Who pays for that work that's done by the title company or attorney? The borrower does. He pays it out of the loan proceeds. So it's not coming out of your pocket, and yet by using these professionals, you get errors and omissions coverage that they may have, and you can also get title insurance, which you should always get when you're making loans. It's also more professional and carries more of a burden on the borrower that this was a real closing, that they got to pay back, or that attorney or title company would get involved again, maybe on a foreclosure basis. So have the attorney prepare a wrap mortgage and wrap note according to the terms on which you and the investor have agreed. Now, you're wrapping that underlying seller financing in this case, remember, Monthly payments work out to $1,312.50 with a balloon at the end of 6 months in the amount of $106,312.50. That's the 15% interest-only payments, and then the balloon is the principal plus the last 15% interest-only payment. All right. If the monthly payments, the monthly payments can be handled in one of three ways. The investor makes two checks, one to the seller for $750, which represents their 10% interest rate on the portion, the 90% that they financed, and one to your IRA for $562.50. Both checks are sent to you, and you forward the seller's check to them. Now, if this is money from your IRA, this is exactly the way you want to do it. You want it to come through your post office box so you can see that the seller's check has been made out by the borrower. You're not just trusting them to make out a check and mail it to the seller. You take that check, you put it in another envelope and send it off to the seller, maybe even put a little note in there that says, "Dear seller, if you have any problems with this check, please call me first," so that you know if a check bounces or there's another issue with that check. And then the second check, the wrap portion of the loan, is made out to your IRA for the $562.50, and you're going to put that in another envelope, probably with a little note to your custodian or third-party administrator like Advanta, showing that this is money on this particular investment so that they can properly credit it to your account. And it's not made out to you, the check. That's important. It's not made out to you. It's made out to your custodian. The other way that you can handle a wrap loan check, and this is the way we handle it outside of the IRA, or if we have a self-directed solo 401k account, is the investor makes a single check to your IRA for the full amount, $1,312.50, and then you send it on to your custodian to send the $750 check to the seller each month. Now, that's going to require a direction of investment each month, and that can be a real hassle, and there's going to be a delay because the custodian can't send out that money until you have that check cleared in your account. So this is the way that that some people deal with the IRA, but it causes just a delay and more effort. The third way you could handle the checks is have a third-party servicer to collect and distribute the monies. That'll cost you $15 to $25, maybe even $30 per month to do that, but that's an option if you'd like to go that route. And then the final checks, when the payoff occurs, can be handled in one of the three ways that we just talked about above.
Dyches, I just want to make a comment about having the check directed directly to the administrator and then having the administrator cut a check. At Advanta, we could have you complete a form that says, please pay when payment is received, and then you would only have to do that one time, and then we would turn the check around as soon as the first check is cleared. So we can make that process very easy, but you are correct.
Excellent.
You have to wait until the money is cleared in order to turn it around.
So they just do one letter of direction to set up the account to be paid each month as checks are received.
Yes. Mm-hmm.
All right, great. That's a feature that all of you should pay attention to. All right, let's look at the results of this the loan that was done. If the loan went the full 6 months, there'd be $7,875 in monthly payments received, but $4,500 had to be paid out to the seller on their first mortgage, leaving $3,375 in earnings on your $15,000 loan. Now, if you calculate that, that works out to a 45% annualized rate of return, which is not a bad rate of return, right? So let's look at how we might also increase that. Again, we have the same scenario we had in the beginning, a house that you found, or excuse me, the investors found that can be worth $150,000 once it's fixed up. For resale, the investor has been able to negotiate an all-cash purchase price of $100,000. House needs $5,000 in fix-up. He wants to flip the house and comes to you to borrow the money. And now you may only have $2,000 left in your self-directed IRA. And by the way, you might have $2,000 in there because you have all your other monies loaned out somewhere else or invested in other activities. So you might, or you might have just started your IRA. So a lot of times you might have a low amount in your account, not because you're just starting, but you've just got the rest of it invested at other places. So this is still a good technique for either one. You decide that this is a good deal. You know others that have money to lend. You show the deal to a couple, and one commits $104,000 at 12% interest only, no points. You then offer the loan the investor the $105,000 total that he needs at 15% and 0 points. Now, in this case, you should certainly get some points because you found all the money, not just a little portion of the money. But I'm doing this for a reason here, so we'll start out with no points. The investor will make monthly payments of interest only for 6 months, then the full repayment is due. If it goes a full 6 months, again, there's $7,875 in monthly payments coming in interest. You'd have to pay out to the other lender $6,240, leaving $1,635 in earnings on your $1,000 loan. Now, you use a financial calculator to get an annualized rate of return, and that's 327%. Now, I like that return yield-wise, but you can't eat yield. I want really a good amount of dollars for the 3 or 4 hours I might have spent putting this loan together and checking everything out. And $1,600 is just not that big a payday, but it is a good return. Let's see what else we can do here. What if we did charge 5 points since we found all the money the borrower was needing? Again, if the loan went the full 6 months, there's $5,250 in points paid at closing. There's $7,875 in monthly payments that are made out to the first lender, that come in rather in interest on the wrap, and there's $6,240 paid out to the other lender, leaving $6,885 in earnings on the $1,000 loan. All right, now we're talking good numbers. Well, what kind of return would that be? Well, you can't even calculate that because the $5,250 were paid at closing out of the loan amount. And so therefore you got your $1,000 back and then some the day that the closing occurs. Now let's think about this for a second. What if you looked at a deal on Monday, sent direction to your custodian, and they sent money into the closing attorney on Tuesday? On Wednesday, the attorney closed on the loan for the borrower and kept out $5,250 in points, and on Thursday sent that back to your custodian to put into your account. So you put out $1,000 on Monday, put back in $5,250 on Thursday. Now, the question is, how often could you make these loans if you were doing that every week? You could do it over and over and over. So you turn $1,000 into $6,800 in just 6 months. All right? Hard money loans are a great investment for your IRA or solo 401k, but you got to be careful. Just as we said in the earlier webinar, you've got to do your due diligence. You've got to make sure that the value is in the property. You need to keep a low loan-to-value ratio and make sure the property will stand for the loan and any repairs that need to be done. You need to get a good education on making loans because, for a number of reasons, but one of the main reasons is you want to make sure that you don't make bad loans. You need to have every chance of a loan going well for you because it can be a lot of money to lose if you're not up to speed on how to do the paperwork and getting the right backups like title insurance, mortgagee title insurance, and so forth. You must have real estate experience to recognize values, identify good deals, to handle any problems. And if you know how to do all that, you can sleep well. Don't pool money or broker funds for others. If you bring somebody in to do a loan and they're making you a loan and you're loaning it out, that's brokering money. So be very careful about that. Don't make a big pool of funds where people are depending on you to provide the profits from the activity of the lending, because that can be considered a security. So be careful about those issues. And don't use all your funds in one deal. Spread them over several deals, so if you have a problem with one, it doesn't affect all of your lending. Now, if you're wanting to learn more about how to be a hard money lender, I'm doing a class. It's the only time I'll be doing it in 2018. I'm doing it April 7th and 8th near the airport in Atlanta. We get people flying in from all over the country. It's usually a smaller class because this is a more niche area. I've been doing this class for 22 years now. I think this will be the 22nd year. I do it with a local real estate attorney who closes a lot of private loans and has some good war stories, which also are educational in themselves. So you can go to assets101.com and find out more about that and can sign up there.
And I just want to mention that I was at the Hard Money Lender class last year. I really enjoyed it. So if you're looking for, getting good education for 2 days, getting a lot of information, it's a great class to attend. If you missed the self-directed IRA class, it was great again this year, and I'm sure you'll have an opportunity to attend next year, but I definitely recommend it. While we're talking, I do want to mention type your questions into the chat box so we can get them answered. We're going to be on here just another couple of minutes, so just make sure you get them typed in. And I have a question for you, Dyches. What obligation, if any, do you have to the first position mortgage? If I know you said a lot of times you bring all of the money to the table the first day and the second by finding the lender for the first mortgage, but what if there is seller financing in place? How do you approach the first position to let them know, or do you let them know that there's going to be a wrap mortgage?
Yeah, if there is a first position lender, they don't worry too often about having a second lender on the property simply because they, being in first position, can foreclose out the second mortgage holder if there is default on payments to them. Also, a lot of times when they find out there is a wrap, which they might not find out until the first payment is being made, I'll send them a letter and saying, we're in the second position. We're going to make sure that you get paid, and here's a check from the bar. If any of these checks ever bounce or you have another problem with them, please let us know first. And I remind them of that every few months. And they like it because now they got two sources of repayment. They got the bar that has signed on all their paperwork saying that they're responsible and has put up the collateral for the loan, and then they have the second mortgage lender that is making sure they get paid from the payment being made on the wrap that wraps around theirs. And so that it really makes most first mortgage lenders much more comfortable.
Okay. We did have a couple questions pop up here. The first question is, what about borrowing from the bank to add money to your IRA for lending? And I'm going to start off by saying there's a lot of moving parts when you're using lending or financing in your IRA, and I'm not sure necessarily, I don't have any experience with borrowing money and then turning around and lending it out through your IRA, but first of all, the loan itself would have to be to the IRA and not to you, meaning you cannot extend your personal credit or give a personal guarantee for any borrowing that you're doing within an IRA. It has to be non-recourse funds. And then I'm going to turn that over to you, Dyches. I don't really have any experience with that.
Well, first of all, if you send $100,000 from a bank loan to your IRA, your custodian is going to send it back to you because you're limited every year to your contribution amounts, $5,500 right now, or if you're age 50 or older, $6,500. So you're not going to be able to borrow big chunks from the bank and put it into your IRA. Now, if you're talking about borrowing the $5,500 from your credit union or bank and putting it into your IRA as a contribution, that is certainly allowed. That's not a problem at all. Remember, the IRA itself, typically you don't want the IRA borrowing money from anyone because if it does borrow the money, it cannot be a recourse loan. In other words, the IRA cannot be responsible directly for the loan. However, if in the case of, say, seller financing, the IRA gets a non-recourse loan on a property where the property stands for the loan but not the IRA, that is acceptable but can also create something called unrelated business taxable income, which we really don't have time to get into today, but is something you need to look into if you are thinking about doing this.
Another question we have is, won't the investor who puts up most of the money want to be on the deed?
Okay, good question. The investor that's putting up most of the money will be on the mortgage that is against the property, not the deed. Remember, the lender is not the owner of the property, and the deed is what shows the owner of the property. But the owner will sign a mortgage saying that he's providing a lien on that property to the first mortgage holder for that big chunk of money. Remember, the first mortgage holder is like a regular first mortgage holder. All the documents, the note, the mortgage are all the same for a underlying mortgage holder under a wrap as if they were just the first mortgage holder on the property, which they are.
Another question we had asking how to get started and find people who need hard money loans. And I would like to just start out by saying I do a lot of networking. There are a lot of great real estate investment groups, I'm sure, in your area because they are nationwide. You can always start by checking Meetup and find out where you can do some networking, and that's what I would suggest. Dyche?
Yeah, that's a good point, Larissa. Remember, your expertise in real estate is going to be a great draw. Let's say that you're talking to someone that has a big chunk of money and you got some small dollars. Let's say you got $6,000 or so in your IRA, and they got enough to plus your, say, 5 of your 6,000 plus 95,000 they've got. You can make a $100,000 loan if you use the wrap structure we're talking about. Why would they be interested in you doing that? Well, first of all, they may not be out there in the marketplace. They can't find the bars that easy. Second of all, they don't know real estate as well as you might know real estate, and they're looking to your expertise to tell them what a good deal is and show them the numbers, not just tell them that this is a good deal, but show them the numbers and prove to them it's a good deal. And even more important than all of that is because you understand real estate, if there is a default, they know that you will take over the property, make sure it gets fixed up and resold so that they get paid out exactly the same as if the original borrower had paid out. So they don't lose any money and they don't lose sleep because you're protecting them. Now, obligations. You do not have an obligation to that first mortgage holder. Remember, the first mortgage holder has an obligation from the borrower. The borrower signed their note, signed their mortgage allowing a lien against that property. You do have an obligation to them for making their payment if the borrower pays you. And that's important. You don't want to have an open-ended obligation to pay them. Now, you're going to pay them even if you don't get paid from the first mortgage holder. You're going to pay from the borrower. You're going to pay the first mortgage holder because you want to protect your mortgage position on the property, and you want to be the one to do the foreclosure, taking subject to the first mortgage and fixing up the property and reselling it. So the first mortgage holder gets completely paid out. You get paid out on your wrap equity, and you get the profit above that. So the first mortgage holder is very well protected, even though you're not borrowing the money from them and reloaning it.
The next question is about age and an IRA. My husband is 61 and can use his 401, and they're asking, can he use his 401k to invest in real estate? And to answer your question, you can self-direct and grow your IRA at any age. There may come a time where you're required to take a minimum distribution, but that does not happen until 70 and a half, and it also does depend on the type of account you have. But regardless of your age and whether or not you can actually add to the IRA money from your pocket in the form of a contribution, you can always grow your IRA. And so, yes, you can invest in real estate investments or real estate types of investments at any age.
Right, and if he's got a 401k with a former employer, I can tell you he will not be able to use that for making self-directed investments because those, even though they say that 401k is self-directed, it means you can choose this mutual fund or that mutual fund. It doesn't mean that you can do the hard money loans or invest in real estate. So if he's left the company, retired, whatever, he can have that money moved from that 401k to a solo 401k, and Larissa can help you get set up with that. Advanta has those, and then he can have a local bank account to make those loans out of.
Absolutely. So regardless of, your age, you can certainly do that. And if you're not eligible to do it through a solo 401k, you can also always roll it over to an IRA to make those investments.
Yep.
I had another question. We want to buy a condo and use the monthly lease as a source of income. Remember that when you are self-directing your IRA, it's very important. All of the income does go back to the IRA account. Now, if you have reached retirement age, you won't pay any kind of penalty to take distributions from that account, but the income itself must go directly back to the IRA or 401k account, and then at that time you would request a distribution from your administrator if you wanted to take it. And you can certainly, after 59 and a half, take those distributions monthly, quarterly, or yearly, however you choose, without paying penalty. Now, your taxes are going to depend on the type of account you have, whether it's tax deferred or tax-free, and then at that time it'll be brought into income for you in the form of a 1099-R.
Yeah, a couple of points, Larissa. First of all, I'm not crazy about actual real estate being in my IRA or my 401k because of the liabilities that come along with ownership of actual property. I like the paper being there, like the loan or option or whatever. But if you are going to buy that condo in your pension plan, you want to have a liability shield, and by having that pension plan set up a single member LLC and buying the property into the LLC that is owned by the IRA or 401k, then you provide a liability shield to keep any liabilities from getting all the way up into your pension plan. So be careful of that. Second of all, if it's a beach condo, say, and you want to go down there for the weekend, you can't. That is a prohibited transaction, and it will blow up your whole pension account if you use it personally. Cannot use it personally.
That's a great point, and as I mentioned at the beginning of the webinar, if you're interested in learning more about the rules, you can certainly access any of our archived webinars on our YouTube channel or at our Learning Center online, where we talk more specifically about the rules for self-directing your IRA. I had another question about accessing the first part of the webinar. I will make sure that you'll get the link when we send out the recording for this webinar in just a day or two, as well as the slides from this webinar. So you'll have the link to both recordings so you can review them when you have a moment. I had another question about long-term lending in Georgia. Are you required to be a registered lender or servicer?
That is a good question. If you are making homeowner occupant loans, yes, you have to be a registered mortgage loan originator or have a mortgage loan originator working with you. All of our hard money lending are to businesses and investors. For instance, an investor is fixing up a property and he's going to get a long-term financing from one of the institutions, but they won't give him very much money because of the condition the property's in. We do maybe a 6-month loan and then get refinanced out from the lender, or someone that's flipping property, or even someone that's buying a property to wholesale it. Those are the kinds of loans we make, not to homeowner occupants, because that has become a problem with Dodd-Frank and the SAFE Act in all states.
I had a question about what happens if the borrower defaults after 4 or 5 months. Will you keep making the first mortgage payment?
Practical answer to that is yes, we will keep making the payments to the first mortgage holder. Do I have to? No, it's not required according to the paperwork. But remember, if I don't make the payments to the first mortgage holder, they have the option to foreclose me out, and I don't want that to happen. So I want to keep them happy. I don't want to stack up late fees or whatever. So I'm going to continue paying them while I'm foreclosing, while I'm fixing up the property and reselling it. Now, if I have an agreement with the first mortgage holder at the time of the default, either ahead of the actual loan being made or even at the time of the default, saying, first mortgage holder, we're having a problem, we're going to get you taken care of, will you accrue it, accrue the payments? And if they're willing to do that, then that's fine. But I want to have that in writing so that we have that agreement. We don't keep accruing late fees, and just allows us to go forward with taking care of the problem. Larissa, did we lose you?
Hey, Dykes, you there? Sorry about that.
Yeah. All right.
So I had another question about getting started. So if you're just getting started, you're not sure how, a great way to do that is to start networking. So network in your area, get with investors that are familiar, ask questions. There's a lot of RIA groups or real estate investor association groups, I'm sure, in your area because they are nationwide. So you can check them out on like Meetup. Another thing is we are going to send out the link to the first part of this webinar where Dyches talks a lot about due diligence. How do you perform due diligence, find out about your borrower, learn about the property that you're going to be lending on. Those are all very important. Your self-directed administrator is not going to perform due diligence for you. So you do want to make sure that you're looking into all aspects of the investment before you go forward with it. And Dyches covers a lot of that in the first part of this webinar, so I'll make sure that you get that recording. I think that's it. If anybody else has any other questions, go ahead and type them into the chat box. I want to mention again the class coming up, Hard Money Lending with Dyches and local attorney Bob Witcher, where you can register at assets101.com. And I'm sure we'll have Dyches on again sometime in the future. We'll make sure that everybody gets the webinar links and slides from today, and you can always email us questions if anything comes up. Well, with that, I'd like to thank you, Dyches, for joining us again. Another great webinar, and we are going to share all the information on our website and on our YouTube channel. And we look forward to having everybody on another webinar with us in the future.
Thank you, Larissa.
Thank you.